let's say someone gives you an adjusted trial balance for a company called the Dancing Squirrel, and they ask you to make a multi-step income statement. So what would you do? Well, the first thing I recommend is you go through the adjusted trial balance, all these accounts, and you identify the income statement accounts. I think the way that's easiest to do that is to cross out all the accounts that do not belong on the income statement. So let's do that. Let's cross out common stock, dividends, long-term debt, retained earnings, equipment, accounts payable, accumulated depreciation, unearned revenue, cash, additional paid-in capital, inventory, accounts receivable, and income tax payable. So all those accounts there, they are not income statement accounts, so I crossed them out. And the accounts that we're left with, like selling, general, and administrative expense, interest expense, sales revenue, those are all the income statement accounts. So now we know what's going to go on the income statement, but it's a multi-step income statement, so we need to make sure that we classify the accounts appropriately. For example, operating items and non-operating items, we have to make a distinction. Okay, for example, SG&A expense, so we will classify that as not just any expense, but an operating expense. So I'm going to put OPER. Okay, so that's an operating expense. Interest expense, okay, that's obviously an expense, but it is a non-operating expense. So I'm going to put non-oper. Okay, so we've got that little abbreviation there. Sales revenue, okay, that's revenue, but it's going to be operating revenue. So that's going to go at the top of the income statement. And then when we look at the loss on disposal, okay, so that is going to go in the non-operating section, okay, below operating income. And then depreciation expense, so that's an expense, but it is going to be an operating expense. Okay, so let's go and let's take a look at our multi-step income statement. Now we'll walk you through this. So sales revenue, we said that that was an operating revenue, so that's going to be at the top. It's not going to be in the non-operating section. Well, you see that here. We got these non-operating items. So sales revenue would not go there. So it's at the top of our income statement. We've got $490,000. We just took the number right out of the adjusted trial balance. And sales revenue, after that, we subtract cost of goods sold. Okay, and that gives us our gross profit. So we have $252,000 gross profit. Now notice, gross profit does not appear anywhere in the adjusted trial balance. That's because gross profit is just a subtotal. Okay, this is not an account. You're not going to look and see gross profit in the adjusted trial balance for $252,000. Okay, it's just the difference between the sales revenue and cost of goods sold. Okay, that's what we're doing with a multi-step income statement. We're going to calculate gross profit, and we're also going to have operating income, we have income before income taxes, and then finally we'll get to net income. Okay, so now that we've got our gross profit right here, sales minus cost of goods sold, we're going to subtract our operating expenses, okay? So, for example, when we said we had our operating expenses, we had SG&A expense, selling, general, and administrative, and then we had depreciation expense. We had classified both of those as operating expenses. That's very common that these would be operating expenses, okay? So we got our SG&A and our depreciation expense being subtracted from the gross profit. So we have the gross profit minus the operating expenses is our operating income. Sometimes people call that operating profit. They mean the same thing. So our operating income is $192,000. Again, that's just our gross profit minus our operating expenses. We had $60,000 in operating expenses. So we got $192,000 of operating income. Now we get to the non-operating items. And we had said that the interest expense, okay, interest expense right here, we had said that that is a non-operating item. So that's very common. If this was a bank, okay, so the Dancing Squirrel, let's just say that it's a retailer or something because they have inventory that they sell, so that's why they have cost of goods sold. So let's say they're a retailer, so interest expense is going to be a non-operating item. But if this were a bank, this were a financial institution, then interest expense would be near the top of the income statement. Okay, so non-operating item, interest expense, and the loss on the disposal of equipment. The loss on disposal of equipment has to do with they sold some fixed assets, so they incur a loss. So we have $9,000 here that is going to be subtracted from the operating income. We get to earnings before income taxes of $183,000, which is another subtotal. Remember, gross profit, operating income, earnings before taxes are all subtotals. Then we subtract income tax expense, our final expense, and we get net income, the bottom line, of $179,000.